Welcome to our Shark Tank Green Bay style event. The only thing after this is the Q&A that you've pre-selected. So this is our last speaker event. It's usually the most fun event, and it's the event that everybody gets the most out of because we've got actual buyers that look at companies all day long, look at probably 1,000 companies a year, and are buying companies year in and year out to give their ideas and thoughts on what is today's value, what are today's structures looking like, what are the value drivers, what are the value detractors. So you as the business owner or the trusted advisor to the business owner can really take a look and say, hey, I've got that, that's good, I should keep doing that, or oh boy, I've got that and they didn't like that, maybe I should try to shore that up, or whatever it might be, and maybe my management team's not as good as it should be, and they really keyed in on that, or whatever it might be. So that's what today is about. Usually it's very interactive, so we're going to do our best to do this with the panel. We've got 3 great private equity firms, and just to give you an idea how these guys and the companies that they buy, right now, just between the 3 firms, they have right around $500 million or $500 million of dry powder looking to buy companies right now. And they've got over $1 billion between dry powder and assets under management. So these guys aren't messing around. That's not their first rodeo. They've done this for years. Some of these firms have been around for a long, long time, which, in some firms, a lot of these private equity firms have only been around for a year or 2, or they're on their first fund. These guys are on their 6th or 7th funds. They've done this and done it very successfully for them and their investors. So we're excited to have the 3 different groups here today. We're going to walk through, we're going to have each of them talk about their firm and their company and themselves a little bit. And then we're going to get into the overview of the company, what kind of things we're going to have them talk about, and then we'll have them jump right into their LOIs. Until right now, they did not know who the other buyers were. We didn't want them colluding on what the offers were going to be. So this is as much fun for us as it is for them to try to see how they pair up with some of their peers. So with that, Brad Odell from Prospect Partners down in Chicago. Brad, can you talk a little bit about yourself and your firm?
Sure. Thanks, Scott. Really appreciate the opportunity to participate here in the Shark Tank. My name is Brad Odell. I'm with a partner with Prospect Partners based in Chicago. We've been around since 1998, investing in family and entrepreneur-owned businesses across a wide range of industries, including light manufacturing, business services, and distribution. What we look to do is back passionate entrepreneurs and high potential companies to hopefully build sustainable, growing, long-term companies out there in the market. And as we get into the opportunity here with Packer Pulverizer, first I want to start with a couple of things that we liked and saw potential in. As Scott mentioned, we see about 1,000 new opportunities in a given year, and so we have to apply a really fast filter in trying to sort through those opportunities, figure out what might be a fit for us and our style, what might not be a good fit, including where we might just not have a great angle, where we're going to be able to compete and ultimately prevail in a competitive process for a good company. With Packer, the first thing that jumps out to you that we liked is...
Hey, Brad, I just want to, let me introduce the other folks, and then we'll come back and get into the deal. But no worries at all. I appreciate, and I even appreciate more that you're from Chicago, and behind you, you have a Titletown towel. So don't think that didn't go unnoticed. So thank you very much. All right. Next, we've got Brian Cohn, Vice President of Zable Companies. Brian, can you give a little bit of background on you or your firm?
Yeah. Hey, everybody. Brian Cohn here. Scott, thank you. Just to echo what Brad said, thanks for having us on, and a pleasure to be here, and excited to talk about Packer. So I'm with a firm called the Zable Companies. We are a small private investment firm out of Charlotte, North Carolina, and what we do is we partner with small private companies, typically family businesses or founder-owned businesses, and try to partner with teams to build those businesses over time. So we have a dedicated pool of capital that's from a single LP, and where we're a little bit unique is we tend to hold our businesses for longer, more in kind of the 10-year time frame. And so as we look at businesses, try to look out and say, okay, how can we build long-term value and partner with teams that value our structure and approach, and think in terms of those 10 to 15 year periods of time. We've been around, our partners in aggregate have been doing this for about 50 years. I've been in the lower middle market for about 10 years, and really excited. I can't say that I've seen a business that's this old in 10 years. So, 135 years of history with Packer is pretty unique. And so that's the first thing that jumped out. But looking forward to exploring it. And Scott, thanks again for having us.
Yeah, thank you. And last but not least, Kyle Madden, partner at KLH Capital, who's can sit from his office and watch Tom Brady pull his boat in and out of his house. So welcome, Kyle, and congrats, I guess, on your Super Bowl win.
Yeah, thanks, Scott. I didn't know if you were going to mention that or if it was perhaps too soon. But I appreciate you having me. Appreciate continuing to be able to call you buddy. My name's Kyle Madden. I'm a partner with KLH Capital based down in Tampa Bay. We manage a pool of $200 million that we look to invest into good growing specialty service, value add distribution, and we do some specialty manufacturing. We'll talk about that actually in the coming moments. But we look for predominantly family-owned, privately held businesses so that we can help them recapitalize, sell their business to their management team, sell their business to the next family or next generation of family, or helping partners buy out, other partners. So we look to invest in both a majority and minority position or control, non-control stake, have a whole portfolio worth of companies all across the U.S., but really look for situations where folks are looking for both capital to accomplish some sort of succession planning goal, as well as bring on a partner to help them grow the business, hire more people, buy more trucks, grow the business into something that they fall asleep to at night versus what they walk into every day.
Great. Thank you all. So what we want to get into now is, so I've got the confidential seller profile up, which is kind of an executive summary that folks would see. And I'm going to give a little bit more background to all the attendees. So you'll have this and you can take a look through it. But as Brian mentioned, this company was established in 1886. So obviously we changed the name because this is a real business that really did sell. But we call it Packer Pulverizer LLC. It's a designer and manufacturer of complete turnkey pulverizing solutions. Their 2020 revenue was $12.3 million. Adjusted EBITDA about $1.9 million. As you can see there, some of the services they provide: project and design, inspection, maintenance and service, manufacturing and spare parts, and testing, consulting, and problem solving. Industries, fertilizer, building products, a lot in mineral processing. Think of aggregates and quarries and things along that line. Steel, oil and gas, power, and more. Their value prop is that design and engineering expertise, success in solving complex problems, specialists with a very high degree of expertise in roller mills, air classifiers, and other equipment, excellent reputation, and you said been around for over 100 years. They've got a strong management team, both in the US and they also have a UK location. And as Kyle mentioned, we have Brett Favre is the vice president of the UK, with David Bakhtiari is the operations manager, and the key US team members, Frank Peck is the manager of manufacturing, Mark Murphy, engineering assistant, Brian Guntz is the purchasing and sales coordinator, and Matt LaFleur is the controller and treasurer. So it's a strong management team, and there's some that will stick around after the sale. This one is interesting that the facilities are and the real estate is actually owned inside the company. Many times it's outside the business in a separate LLC owned by the business, but this time it's inside the company, both locations, both in the US and the UK, which we'll see how the buyers handle that. They're sitting about 60-40 in sales in out of the UK office versus sales out of their United States office. And UK covers Europe, Asia, Africa, Australia, New Zealand, and the US office covers US, Canada, Mexico, South America, and Central America. So that's kind of how they break out those divisions. Their top customer the last couple of years is about 35% of their business, and after that it drops off to about 7%. They typically have different customers each year. It's more project based, and so there's diversity in their top 5 customers from year to year. It's not the same customer base, which there's pros and cons of that, which I'm sure they'll talk about. And they work with about 80 to 100 customers throughout the year. And as you can see from the screen, their revenue is kind of bounced around a little bit. So it's they've had some good years, some not so good years, and we can talk. I'm sure that we'll want to talk a little bit about how that affects valuation or structure with a little bit of a yo-yo effect to both revenue and EBITDA. And their margins have, they've had one really strong year in 2015, which was 26% for EBITDA margins. And then it was 19, 11, 16, 22, and 15. So again, they bounced around a little bit there as well, being capital equipment and kind of larger purchases. So that's a little bit of overview. Again, very, very high level of the company, along with what you can see on the screen. And now we want to get into first of all, we're going to talk about the categories. So the categories that we're going to get into is, what was the value that they had? What was the structure that they thought made the most sense for a deal like this? How much cash was that closed? Was it an asset or stock deal? There's pros and cons of that. Seller equity rollover. Did they look for rollover or not? And that's again where I'll let them explain it so we can save some time because I'm sure that they'll get into that of how that works. Due diligence, how long? Is this going to take 60 days, 90 days, 120 days, 180 days to get from that signed LOI to close? Estimated hold period, you heard, I think Brian talked about, they hold maybe 10 years or so. Is this a 5-year hold, 7-year hold? And again, I know sometimes it's up in the air of when it makes sense for both management and for yourselves. But kind of maybe what's your average hold with your last several companies that you've had? Working capital peg. This is one that a lot of people don't, business owners have a hard time understanding. But in most companies in the lower middle market, there you have to take a look at your receivables plus your inventory and prepaids minus your accounts payable and accruals, and what is that net number? And typically going back over the last 12 months, or there's other methods to use, but what is that kind of, we call it the gas in the tank, what's going to be left in the company? Because a lot of times people don't think of that should be left in or needs to be left in or calculate that into in their company. And there's a lot of things that you could do as a business owner to save a lot of dollars with working capital by being efficient with working capital, where most aren't after 20 or 30 years. Escrows, caps and baskets, any other thoughts? And then, what were their transaction expenses and what do they spend their money on? And then ultimately, what is that multiple? And when we talk about multiple, that's basically just taking the normalized EBITDA that they used and whatever EBITDA number they had, the purchase price divided by EBITDA gets you a multiple. So if it's a 2 million EBITDA company and a 10 million sales would be a 5 multiple. So that's what we're going to be talking about today. And the first person that we have up is prospect partner Brad. If you would like to talk to us a little bit about your value and structure here as you kind of walk through your letter of intent, that'd be great.
Yeah, sure. And maybe to start quickly with, starting to talk about one thing that we really liked was the long heritage and strong reputation that the business has in a highly engineered, complex niche market, which is really special. And as Brian noted, it's not every day you see a business that's been around for 135 years. So when something like that comes across our desk, we're going to be interested to start and at least want to make sure we understand the market, the way they're differentiated, what the opportunities are, and what you can really build. On the flip side, and it's reflected in our valuation, which is candidly a lower multiple. There's a number of challenges that I think any institutional investment fund or firm would have to really dig into and understand to be able to get an investment done in this space. Is just the lumpy, large capital project nature of the products here is a real challenge. There's minimal recurring revenue. The changeover in customers from year to year is really difficult to underwrite, and so it would really push the multiple towards, I think, the lower end of the market, which is, for us, as we thought about it, we thought a 4 times multiple would be how we would approach it, and we would put the 4 times on a average EBITDA that over the last 5 or 6 years. We had 6 years of results, so we use that. Given the lumpiness and the cyclicality of that of the market here, we think that helps provide a baseline EBITDA. And so you're not just bidding off of 1 strong years of results, where maybe there's 1 project that helped drive the earnings in the most recent period, but that's not going to be sustainable or recurring in future years. And so that's a simple way to try to come up with a way to value the business at a high level. Another approach would be to look at the net book value and the assets in the business. We didn't have balance sheets, so we didn't look at it that way here, but that'd be another way to kind of sanity check what the overall valuation could look like in terms of the deal. The other challenge here, which is reflected in the structure, is just the financing opportunities for this business we think will be challenged. Now, a large part of that is connected to the valuation multiple, but it's complicated by the fact that their operations both in the US as well as in the UK. A lot of smaller lenders won't feel comfortable looking at opportunities with that type of exposure and operations spread out where they can't have quick access to the assets and be able to be closer to the business that way. And the other real big challenge that I'll mention is the exposure to some emerging markets like Egypt, which was the largest market in the last period. That tends to be even more difficult to finance given the currency volatility and the overall economic cyclicality that can occur in those types of emerging markets. So there's some challenges that we try to get creative with here. The structure is roughly a 50% cash at close offer. We did ask for a $1 million subordinated seller note, and then as well as $650,000 of rollover equity from the owners here, which would equate to about a 20% ownership on our capital structure. And the other thing, which I'm sure we'll spend more time in, is it was trying to get creative around the real estate. It can be very difficult to get real estate out of an entity, a corporation like this one. We did assume that we could figure that out from a tax perspective, and so we assumed that we would spin those out, sign fair market leases on both those facilities with the sellers. We looked at some comps in the Green Bay and Bristol, UK markets where the facilities are to try to put a rough number on it. We'd want to get that validated by a third-party appraisal, assume 20% triple nets, and then lowered the EBITDA by that amount, which the 4x multiple goes on top of there. So part of the value there is really just valuing what that lease income stream would be to the sellers. We use an 8% cap rate. You could figure out, you make your own decision whether it's high or low, but felt relatively appropriate with a long-term lease. And then we do think an asset deal would be really advantageous, create some nice tax shields and advantages for us, which would help make the returns work for us. Due diligence time frame, we put out 120 days, which candidly is longer than we would normally lay out. With an offer, typically we'd be looking to be more in the 60 to 90 day range. We added some extra time here given the international operations, which would take a little bit longer to work through. There's some different legal considerations doing deals with international assets. And then also just going back to the real estate, it would take some extra diligence and time to help try to figure out if we can spin those out into separately owned facilities. Hold period, we typically go into a deal underwriting a 5-year hold period. We're a little bit more flexible than that. Usually our hold periods range from 5 to 7 years, but we go into a deal with a plan to hopefully create some value and grow the business over a 5-year period. Here, that's going to be a big challenge. The growth vision is not very clear and articulated. For us to be able to do this deal, we need to see a path to really grow the business or help evolve it, change it into something that it is more than what it is today. Because one of the biggest challenges for a private equity firm such as ourselves is we can't take a small business that's basically the same size as when we bought it back out to market. Those businesses tend to be really hard for us to sell. And that's a big consideration when looking at a smaller business that has not had a good growth trajectory in its recent path. Working capital peg, we didn't have the balance sheet to look at it closely, but a simple 12-month average would be the most common way we would look at it on a cash-free, debt-free basis to help make sure that there are sufficient assets to maintain and generate the earnings that we are valuing the business on as a part of our offer.
Hey, Brad, just jump in there. One quick question for you in your structure. With the subordinated note to the seller, what is your typical time frame for that note? Is it paid out over 2 years, 3 years, 5 years, 8 years? What do you typically see if you're asking a seller to hold a note in a
great question.
position?
Yeah, we typically look to start with a 5 or 6 year subordinated note. It would need to sit behind and outside the senior credit facility at least by 6 months or so. So it can be in that 4.5 to 6 year range is typically where we would start. And usually a modest cash interest payment on that, typically, a 5% kind of multiple that can be negotiated a little bit, but that's where we would start on a fairly kind of market basis. There would be no amortization as part of that note, but we would do our best if the company grows and pays down the senior debt to look for opportunities to help refinance out that seller note if that's what the holder of that note wanted. Sometimes they're happy to hold it out into the future and enjoy that 5% cash payment, but it'd be something that we would need to do when permitted and when encouraged by the senior lender.
Got it. Thank you. All right, jump over to the escrow.
Yeah, escrow here we think would be pretty standard. 5% of purchase price. I think a cap of 10% here is somewhat down the middle of the plate. Unfortunately, this deal I think is still a little bit too small to use a rep and warranty insurance policy, which would allow for a smaller escrow as percentage of closing. We would be willing to explore that, but in our experience, it'd just be a little bit too small to make the math work and make it even more attractive for the seller. And there could be some buyer advantages there as well. Basket 1%, really kind of just trying to aim for middle of the plate starting point. Obviously you'd want to diligence the business further. Maybe there'd be a need for special indemnities along the way, but we're going to start with pretty much the out of the box standard approach. The leases, we'd be looking to sign fairly standard market leases for long-term, usually a 5-year initial term with long-term options controlled by the business. It would be difficult to move these operations from the pictures and the materials that we got, so we would want to make sure we control the facility and the real estate for as long as possible. In terms of expenses, I mean, this is a relatively small deal at $8.5 million. We would need to be really efficient from a transaction expenses, so the expenses weren't really kind of swamping the size of the deal and diluting returns. $600,000 felt like a fair place to start. The financing costs would be relatively minor. Most of it would really be in the form of legal, some accounting work, which we can be pretty efficient with, and maybe a small market study to help us give us a little bit of a market map and better feel for the industry. And a lot of the point of that would really be, underwriting an opportunity to maybe do some acquisitions of similar capital equipment type businesses with complementary end markets, things like that. So it would not just purely be a due diligence exercise, but really we'd be trying to work on and fine tune the value creation plan as we look what we can really build with this company, which is ultimately what we're focused on. What can we do with it? How do we turn it into a $3, $4, $5 million EBITDA business that's growing with a full team? When we go to exit the business down the road, that's what's really going to get us excited and help us get the deal done.
Great. Thank you so much, Brad. All right. Next up is Zable. Brian from Zable Companies. Can you share with us your thoughts?
Yeah. Sure. Hey, Scott. In the way, I guess just starting off, one of the things that we would probably want to get a better understanding of on the front end is just George's goals and objectives, the leader of the company, and probably Brett as well. Brett Favre, who runs the UK business. Would imagine having Brett Favre on your team would be a good way to go, and would be excited about him continuing. And but for us, right, it's our level of interest and how we structure is in a lot of ways based on kind of the goals and objectives of the owners of the company and the team that's running the company. So for this purpose, kind of had a working assumption that George was interested in continuing to run the business and have an ownership stake going forward. And then his parents, who I believe owned 49%, inactive in the company, would cash out. Similar to what Brad mentioned, a business like this on the surface, with the lumpiness, we would look at it on an average of EBITDA over some period of time. We used 3 years for this purpose. And so we took an average of 3 years, applied a 4.5 times EBITDA multiple to get to $7.3 million of enterprise value. And I would agree with Brad's statements on the debt side of things. I think, for us, would feel pretty good about hopefully being able to go get a turn of third-party debt at that 1.6 million, which is the average of the last 3 years EBITDA, which is probably how a lender is going to look at this as well. And then would ask for the sellers to also finance about a turn for call it 2 turns of total leverage, and the rest being equity, 80% of which would come from us, and then 20% of which would be rollover equity from George. The cash at close, which is the 5.65 there, is just the difference between the enterprise value and the seller note of 1.6. We also had this structured as an asset deal. Depending on what the ongoing liabilities looked like and any risk there, we could potentially evaluate an equity purchase through a conversion to an LLC and doing an F reorganization where we'd have the same tax benefits. Given how long this business has existed, it might be difficult to validate that, but we'd have to do more work around it. we talked about the solar rollover equity, about 900,000. I guess just taking a step back, one of the things that initially as we looked at this, we liked and we want to validate this is just the large installed base. I think they had equipment in about 40 countries. They appear to have a sort of an aftermarket parts and service spare parts component of the business, and would be interested in understanding how much of their sales and profitability is driven by that part of the business, and to the extent there's a nice baseline that you can count on every year, and then maybe you have some projects that kind of have spurts of growth in and through a year. It'd be interesting to kind of understand that a little bit. Our working assumption has been that there's a baseline of aftermarket business to support, some good baseline profitability.
So Brian, just from for our attendees' purposes here, the more maintenance type work or reoccurring revenue where they're touching these customers on an annual basis for a calibration or something along that line, that would bring more value than if it all was just a one-time sale and transactional, correct?
Absolutely, yeah. The recurring revenue, the repeatable nature of as much of the business that's in that realm is going to be more attractive because it's just more, it's more stable, more recurring, more repeatable. You don't have to go out and win business every year to maintain a level of earnings. That said, we certainly recognize right with this business, probably with these projects and putting more of these pulverizers in the field, it's just generating a larger installed base, which ought to drive additional recurring revenue. But you're absolutely right, Scott. The more of the business that's of that recurring testing, maintenance, spare part business is going to be more attractive.
And that would move, so even if the sales and EBITDA were the same, but that mix was different, that would most likely increase the multiple that you would offer on something like that.
That's right. That's right.
Yeah.
So that would be something we'd want to understand, to the extent that, for example, 80% of their earnings were from the aftermarket, parts, testing, services, that would probably lend itself to be a better multiple, to the extent that more of their earnings in a given year were projects or, large orders that weren't necessarily going to repeat year in and year out. That would probably, require a different look at the multiple we'd be able to pay for that business.
Got it.
And it may also change how we use debt in the transaction. So moving forward here, on the due diligence timeframe, would echo what Brad had mentioned about just some of the complexity with the UK business. Would also want to make sure we spend adequate time with Mr. Favre over there and learn about all the keys to his success over time. The other thing I'd mention just right now, we've done 2 platform acquisitions during COVID, and everything's just taken longer right now. So to the extent that this came across our desk at the current time, service providers are taking longer, diligence is taking longer, travel, being able to, build rapport and trust with teams is taking a little bit longer. And so we found it prudent to just plan for a little bit more time post LOI. On the hold period, as I alluded to in some of the opening remarks, we typically are holding businesses for 8 to 10 years. Sometimes we exit earlier, sometimes we exit after longer periods. So, 5 to 15 years is sort of the range that I set out here. In working capital, this is another, thing we probably want to explore a little bit. The P&L, the income statement tells, part of the story in terms of the cash flow characteristics of a business. The working capital, CapEx in a business is important to understand to get a more holistic view of the free cash flow profile of a business from how we look at it. And so that's more of a macro statement. Generally with working capital, we look at an LTM average of some sort. It's not meant to be a value driver or detractor for anybody. It's just meant to ensure that the appropriate level of inventory, AR, payables, et cetera, convey to us as a buyer to adequately support the business going forward. From an escrow standpoint, we use 15%. A deal of this size, we would typically have a little bit larger of an escrow. I think with the seller note, we might be able to get comfortable to come down on that a little bit. On the cap, we typically match the escrow to the cap, and then a basket of 1%. Similar to what Brad mentioned, I think the rep and warranty insurance is a really interesting product, and it's coming down to smaller and smaller deals, but I don't think it's quite at this level yet. Would be curious to get the perspective of Kyle and Brad on that. But that's how we looked at the escrow and the cap and the basket. I did want to mention in terms of other, right? Typically when we're submitting a letter of intent, it's to us, it's a handshake, right? This is a deal we're confident we can close on, and are really excited about it. And based on what we know here, we'd still have some questions we would want to understand before we were in that position. And so just thought that was important to highlight there. On the buyer transaction expenses, $500,000, it is a small deal. Most of that would be in legal and some closing, debt transaction costs, some accounting, diligence costs, et cetera. That's probably the appropriate level here. And then on the front end, I alluded to the multiple of just being a 4.5 times multiple of the average of the last 3 years EBITDA. But really interesting business. Love the install base. Ideally, there's a fair amount of recurring revenue that's coming from that installed base versus some of that project, lumpiness that you see that we want to kind of understand a little bit. But interesting business to learn about, and would definitely be interested in taking the next step in this kind of a structure.
Great, thank you, Brian. 2 quick questions for you. First one, your escrow of 50%. How long typically are your escrows? Is this 12 months, 18 months? What does that look like? 2 years?
Yeah, usually it's a good question. Between 12 and 18 months, we like to get a full year audit cycle, typically before we're releasing the escrow. Sometimes we have it staged. A piece of that will be a working capital escrow where we'll hold back, maybe 5 of that 15% is held back until the working capital true up post-transaction happens. And then the rest of it would release in maybe 12 to 18 months.
Got it. And the working capital true up is what, usually 90, 120 days from close?
That's right.
Okay.
Mm-hmm.
And last question, again, for the listeners here. So basically what we gave you guys was the executive summary and a SIM. And a SIM that, like you said, didn't have a ton of information, but a decent amount of information that you guys would typically see. Just maybe just briefly, what are those top 2 or 3 other things or questions you do, or talking with someone, what would you do to get more comfortable and put together more of an LOI that you thought you could stand behind?
Yeah, I think the most important thing would be time with George and Brett. And just kind of understanding their vision, their, where they see opportunities in the business, their goals and objectives. We'd probably want to get a better sense for growth opportunities here. How are they positioned in the market? It looks like a niche market. Is that growing? How much share do they have? And then just the mix and the profitability between the recurring nature of the business and the project sort of stuff that you maybe can't count on year in and year out, which we talked about earlier.
Great, thank you. Yeah, just to give the listeners some ideas of what other questions or what other things you might be looking for as buyers. And now we are jumping over to Kyle over at KLH. Mr. Madden, would you like to give your thoughts on value?
Yeah, so we were actually pretty excited about this one, primarily because of what we can do with the business. I think the business in its current state has a great installed base, although I think you're seeing the cyclicality of being tied to the customer's more capital budgeting opposed to the maintenance CapEx. So we have good experience with this type of business with these exact same end markets. We exited a business that does field services specifically to the phosphate processors in Florida and Utah and Idaho and actually Saudi Arabia and southern Canada. So we dug in pretty deep here. We proposed an enterprise value of $11.5 million. We would ask George to roll for 20% of equity. We had about a $5 million check for KLH's equity. He would roll for 20% of that, or about $1.25 million from George to earn that 20%. So you're ultimately looking at cash at close of $10.25 million here. What we liked about the business, guys, is that this, I think you've heard it from the other two groups. I mean, being on the manufacturing side of this sort of OEM equipment, it no doubt is cyclical. I mean, all of the end markets that this company is exposed to is cyclical, and they do cycle. However, these industries aren't going away, and they typically cycle at different times. So, for example, phosphate is mined. It's a strip mining process. Phosphate goes into fertilizer, which then grows crops and food. So we're a big proponent of a number of these end markets. So things that we liked about it, again, what can we do with this business? We can leverage the installed base to really ramp up the parts distribution, the parts fab, and the field service here. Because one thing that we know is if you're manufacturing or fabricating this type of processing equipment, there is a whole host of ancillary equipment that is located at these processing plants, or ultimately our customer base. There's pumps, there's gearboxes, et cetera. So there's a whole lot of parts fabrication that you can get into, field service that you can get into, pump and gearbox rebuilding that you can get into. We have experience building rep relationships or distribution relationships with pump and gearbox guys selling into phosphate and cement. So we know the guys at Weir, we know Lewis, Andritz, Bobini, Warman. So I think those are phone calls away for us, and I think we reflected that in the valuation. So I think the guys are absolutely right about the manufacturing side of this being quite cyclical. If we can go out and not pivot the business, but add on the field services side of this business, that's really where you can get some multiple expansion as well as some scalability. So we liked this as a platform because of what we can do with it. Now digging into more of this offer. So I mentioned a 20% rollover for George. If we're doing our math right, George has got to be probably 75-ish years old. So he's getting up there. And bless his parents for owning 49% of this business. They've got to be 95, 100, 105 years old. So we're getting up there, guys. So we need to think about some succession planning and spending time with George and the management team to ask George, who else should be an owner here. I think a natural pivot to George's successor, if it doesn't already exist in the business, is to go to its customers and see if there is more of a seasoned executive there that can jump ship to our business to lock in those customer relationships. We have done exactly that beforehand to lock in a customer relationship that was quite significant. So we would want to see him roll for 20% of the company right now. I think as we looked at the organizational chart, a lot of this business still is George. So I think we need George. We need his kind of brain trust and knowledge for the next couple of years, but we do want to focus on succession to allow him to retire if that's his goal. I do want to make a note that we pointed out that rollover equity, depending upon how much we can study in on idle labor, I think that's one big thing with these types of fab shops is studying idle labor and properly allocating idle labor per job. there's a lot of fat in some organizations like this by studying idle labor. So that rollover equity, without doing any add-on acquisitions, we think should be worth about $3 to $8 million, depending upon how much we can scale EBITDA. So there's good potential for a pretty hefty second bite here. The due diligence timeframe, we're proposing 75 days. Again, I think that's pretty fair. I think what the other guys on the line here suggested are absolutely fair. I think Prospect was out 120 days. Zable was out, I think, 90 days, if I recall correctly. I think we went rather short here at 75 days, just merely because we know the space, we know the right questions to ask, we know how to diligence this type of business. So even in a COVID environment, we felt fine with that. The estimated hold period is a great thing to look at, guys. I think that's the right question for the sellers here and for Scott as you advise these companies, because everybody has different hold periods. Like the other two groups here, we are also flexible. So while we model a 5-year deal, we really rely upon management, and in this case, George or George's successor, to call us when it's time. And on average, that's kind of 5, 6, 7 years, but we've been in as long as 13 years. We've exited as soon as 3 years. So it really depends upon what management wants to do and what collectively we've done with the business and what the industry and what the market looks like. The working capital peg was interesting here. To the best of my knowledge, we didn't have access to a balance sheet. So we proposed $740,000. How we got there was we simply looked at the working capital dynamics of another very similar business to this that we've previously invested in, and applied that to its revenue and cost of goods sold, and ultimately came out with $740,000. So, I don't know if that is exactly right, but I wanted to put a dollar figure into here to help sharpen up the offer. Escrow's 18-month traditional escrow, basic 10% of purchase price, so 1.15. Echo what the other two groups have said. This size business is just too small for rep and warranty insurance right now. I think you may be able to actually get a policy for it, but the premium dollars, in our opinion, wouldn't make any sense. So traditional escrow, caps and baskets, I think traditional cap of 10, 1% basket, 150 grand deductible is about a $300,000 retention amount. The structure in the other category, just to walk it out, we had 3 times total leverage. It was actually a little bit less than 50% of the total capital stack, but call it 3x leverage, 1x coming from a senior facility, as well as 2 turns of EBITDA from a subordinated or mezz shop. The sub debt guys can be a little bit more expensive cost of capital, but it's a balloon payment, so it's just less cash leaving the business overall on a quarter-by-quarter basis. So we're big proponents of that, so that we can reinvest the cash and hold it, because again, this thing can cycle in its current form without that field services component. And then obviously I mentioned $5 million of a check from KLH. George rolled 1.25 of his proceeds. We think a deal for this size should be $750,000 of overall transaction expenses. And we looked at both a multiple off of 2020's EBITDA as well as taking a blend. So I think it was about 6.1 times the 2020 EBITDA. Because of the volatility, it was higher. I think it was about a 6.8 times average when you looked over the last 6 years. But again, I can't reiterate enough, this business is indeed exciting for us because of what we can do with it on the field service side and parts distribution side. We've been there, done that before. When you're the guy that's manufacturing the capital equipment, yes, that can cycle, but you also have a captive installed base to then fabricate replacement parts. And you can probably structure an agreement where they have to buy the replacement parts from you. And then if you're able to be local to your customers, And that's one thing that we would want to sit down and understand is the proximity of your customer base to this company. But if you can open up a location to be closer in proximity to your customers, there's a lot of field service maintenance that goes on, whether in the mining equipment, the conveyor belting, the gearboxes, the pumps, or this equipment that we're selling right now. Somebody else is doing that. I don't think it's this business, just given the volatility of the trends. And that's a really, really nice way to capture more of your customers' spend, actually at a higher EBITDA margin on that side as well. So all in all, guys, at the size of this business, we would actually be a pass on this because it's too small for KLH. If this was around 4 million of EBITDA or up, we would jump on it. But I think knowing what we know about this business, how to grow this business, and the end markets that we all have good experience with here at the shop, we would lean in pretty hard.
All right, great, thank you. Let's bring up everybody on the screen. We just got a minute or two for a couple quick questions. I guess, Kyle, just briefly, could you talk about the real estate being in the company? Would you leave it in the company? Would you do the deal at your size and then do a sale leaseback and pull that money out to pay down debt, or what would you do with the real estate?
We would leave it in. That's a key component to these types of businesses, and that was actually one question that I would have for you and George, is based on the size of the facilities right now, what's the capacity? Because I think if we get into more of the parts fab and the field service, we're going to be bringing in larger and larger pieces of equipment. So we will be adding on to this real estate considerably. I think they had, if I'm not mistaken, about a 30,000 square foot facility. This business will need about a 75,000 square foot facility. If we do what we can, perhaps even larger than that. So we would want to own the real estate. We want to own the dirt because we want to expand on that.
Great. And then briefly, Brad, what would be the number one thing that you liked about this business?
Yeah, I think it goes back to the long-term reputation and brand in a very specialized, highly engineered product category. And I think Kyle made a lot of nice points about what you could build around that from an ancillary product and add-on service component. And that's going to all come back to their reputation, their customer relationships. What else can you do with it? And I think it'd be a really important part of the story. If they're already doing some of those things, it's really helpful to understand that as part of the story with the investment banker. Even if management has a vision for how they can go after that market, I think really laying that out up front so buyers and investors like us can really start to dream on what you can build with this business up front, I think it can be really powerful, for the process and getting to a good outcome. And then if you've got a management team, again, maybe it's this management team's a little bit older, but if there's a management team that's going to be really dynamic, really explain the vision, I think there's going to be a really strong incentive to getting that management team out in front, doing some calls earlier in a process with folks like us to get us excited. Hear that vision. Maybe you're not seeing it in the numbers yet, but here's what we think we can build if we have the right capital partner. And so I think if you can invest in that upfront process, can be pretty successful.
Great, thank you. And last question, 30 seconds, Brian. If you were going to tell this business owner to work on one thing to make it more exciting or more valuable, what would be that one thing that you would have them work on?
Growing the aftermarket business. Getting good data on how much they're actually capturing of their installed base, and growing that part of the business, because that's where the enterprise value and the value of the business will grow more significantly, is by driving growth in that part of the business.
Great, thank you guys so much. I really appreciate all of your time. Again, you could talk about take out the lumpiness out of the sales and EBITDA. Understand, try to create that recurring revenue, have that strong management team, understand what that vision is, and be able to paint that picture of where this company could go. Sounds like all great items along with a bunch of other things. So again, these guys all have $500 million between the three of them to spend. I think it's burning in their pockets right now. They want to spend some money and find some great companies. So if everybody has anything, these are all good people, great guys, great firms, and we'll feel free to reach out to them. Thank you. So I just want to thank the sponsors. We cannot do this without our sponsors. So the Business News, Nicolay Bank, Baker Tilly, Nicolay Wealth Management, Imaginasium, Gillespie Productions, and Von Briesen, our platinum sponsors, and our gold sponsors, Journey Consulting and Leonard & Finkel Public Relations. You guys not only have you supported this great project and event, but also have brought in some great top-notch speakers and thought leaders and have given a lot of education to everybody here today. I want to thank all you attendees. Again, over 350, our biggest and best yet on our third year of doing this. We'll be live hopefully next year. But again, if anybody has any questions, if we can help with anything, we're a resource here. Here's my information at Cornerstone. And when you talk with any of these sponsors, I'll show in a second, any of the sponsors or anybody that we want to talk to, the speakers, they understand confidentiality. So don't not pick up the phone or send an email because of that. They've all told me they're going to return your phone calls. They're going to answer you. They're going to be a resource for you. So again, thank you all for listening in today. And before we get to the last session, which is your Q&A session, again, you've pre-chosen your Q&A session. Just click on that. It starts at 3 o'clock or thereafter, and then and that'll be for 30 minutes. And then after you're done with that, you're wrapped up. But before you leave, typically we can hold the feedback survey. We can hold that over with drink tickets. Well, we don't have drink tickets to give you this year, but I promise you that we will give you an extra drink ticket next year if you can fill out the survey, because we do take the time to listen to this, and it makes each event better and better. So just take a minute or two, fill out the survey. And then also the Business News Supplement. This is here on your left-hand side of your screen. We've put together a multi-page report. It's got all kinds of educational articles from all the team members and thought leaders. So print that out. Put that in your file if you're looking to grow, you're thinking about selling down the road or preparing, because these are, again, the experts that do what they do. They're all specialists in their field. Or if you want to grow the company, obviously there's other areas for that too, to learn about growing, building your brand, as the private equity firms talk about, enhancing that brand and building more awareness. That all comes through public relations and other things you can do online that some of the other speakers talked about. And that is the last thing that I have. I want to thank you again for taking the time to be with us today. Our third annual, we can't wait for our next year to be live and see all you face to face again. But again, enjoy the Q&A. The speakers will all come up and you'll have plenty of time, 30 minutes to talk with them. And if you don't feel comfortable asking the question with the other people on the line, again, feel free to jump over and send them an email, give them a call after this, and they'll be happy to take care of you. So continued success, thank you, and have a prosperous 2021.